Have you ever signed up for a new streaming service? Maybe one that bundled in a smart home device or, bought software online that came with a year of premium support. From your side, it seems pretty simple. You click buy, money moves, job done.
Right.
But what if I told you that for the company, figuring out the revenue from that, well, that seemingly simple transaction is actually way more complicated than you might think. Welcome to the deep dive. Today, we're plunging into the really fascinating world of how businesses recognize revenue. Specifically, we're looking at contracts with customers under IFRS 15. That's the International Financial Reporting Standard 15. Now, this isn't just like boring accounting stuff. It's genuinely critical. It's how companies report their performance, how they look to investors, to the world. So the core idea of IFRS 15, it's about companies recognizing revenue when they hand over promised goods or services. And they recognize it at an amount that reflects what they expect to get in return the consideration. Our mission today is to unpack this practical 5-step model that businesses everywhere use to apply this principle. Seriously, understanding this model gives you such a unique insight into how modern businesses actually operate. It sounds like a real roadmap. I'm actually pretty keen to see how these steps fit together. Okay, so this 5-step model, it's basically a universal framework. Almost all revenue deals, doesn't matter the industry, think of it like a financial GPS for navigating these complex contracts. So the 5 steps are: 1, identify the contract with the customer. 2, identify the performance obligations within that contract. 3, figure out the transaction price. 4, allocate that price across the different performance obligations. And finally, 5, recognize the revenue when, or importantly, as the company satisfies each obligation. Let's maybe use an example. Imagine a company, let's call them StreamCloud. They offer a premium streaming service, but it's bundled with their own brand new smart home speaker. How do they account for someone signing up for that bundle? Okay, let's unpack this using StreamCloud. It all starts with step 1, identifying the contract, foundational stuff. And you might think a contract is just, a formal document. But under IFRS 15, it could be written, sure, but also verbal, or even just implied by how they normally do business.
Exactly. And for it to count as a contract for accounting, it needs a few key things. It has to be enforceable, obviously. It also needs commercial substance, meaning the deal actually changes the company's future cash flows or risk profile. It can't just be swapping identical things back and forth.
Right. Makes sense.
And both sides need to have approved it. Payment terms have to be clear. Crucially, the company has to think it's probable they'll actually collect the money. And the rights for each party, what they get, what they give, need to be identifiable.
Okay, but here's where it gets interesting, right? What if a contract doesn't tick all those boxes right away?
Good question. The company actually has to keep checking. It's not a one-time thing. They need to reassess if circumstances change. And another thing, sometimes StreamCloud might sign, say, 2 contracts with the same customer at roughly the same time. IFRS 15 might require them to combine those and treat them as one single contract, depending on the specifics.
Oh, wow. Okay.
Yeah, and even just changing an existing contract, a modification, that can get complicated too. Sometimes it's a whole new contract. Sometimes it just tweaks the original one.
It sounds like trying to untangle a really messy knot sometimes. You think you've got it, then there's another twist. It really seems like getting this first step absolutely spot on with all these nuances is just critical for everything else, isn't it?
Absolutely critical. You've really hit the nail on the head there, because if you get the contract wrong at the start, well, everything that follows is built on a shaky foundation. What's fascinating here, I think, is that IFRS 15 sees a contract not just as a static piece of paper, but almost as a living agreement that needs ongoing attention. Getting step 1 right isn't just about compliance. It's about truly understanding the economics of your customer relationships as they evolve. A mistake here can ripple through, potentially leading to misleading financials. That impacts investor trust, maybe even legal issues.
Okay, so StreamCloud has its contract identified for the bundle. Now we hit step 2, identifying performance obligations. This is where it gets even more detailed, right? Because one contract, like our StreamCloud bundle, can actually contain multiple promises, multiple commitments to the customer. People often call this unbundling the contract. Each separate, distinct promise or performance obligation needs to be identified right at the start.
That's right. And the key word there is distinct. Is the promise distinct? A good or service is distinct if basically 2 conditions are met. First, the customer can benefit from it either on its own or with other resources they already have easy access to. And second, the promise is separately identifiable from other promises in the contract. It's not, highly integrated or dependent on another part of the deal.
So for StreamCloud, The streaming service, you could watch that on your TV, right? And the smart speaker, you could use that with maybe another music service. So they seem distinct.
Precisely. The customer can benefit from the streaming alone and the speaker alone, and they aren't intrinsically linked in a way that makes them one single item. So yes, two distinct performance obligations here.
That whole unbundling idea, it always seems to catch people by surprise. It sounds like a lot of work, especially for a big company like StreamCloud with maybe millions of customers and different offers. Is that a common headache for businesses?
Oh, absolutely. It can be a huge operational challenge. And you're right, the standard gives indicators for distinctiveness, not rigid rules. This means management has to use significant judgment. They need to figure out what breakdown best reflects the actual economics of the deal. Now, sometimes, if you have a series of distinct but very similar goods or services delivered over time in the same pattern, think like a monthly cleaning service that can sometimes be treated as a single performance obligation, which simplifies things a bit.
Okay, that helps.
But conversely, if you deliver something, say, software, but it's totally useless without a specific piece of hardware you haven't delivered yet, well, then they're not distinct. You'd have to bundle them together accounting-wise until you've delivered enough for the customer to actually benefit.
Right.
I think the biggest frustration we hear is that companies really had to rethink how they viewed their products, not just for sales, but for accounting. It forced a focus on the economic substance, even when that substance is complex.
Okay, step 3 then. Determining the transaction price. Sounds straightforward.
Yeah.
How much money does StreamCloud expect to get from the customer?
Broadly, yes. It's the consideration the entity expects to be entitled to, but an immediate point.
Right.
You exclude amounts you're just collecting for someone else, like sales tax for the government.
Got it. But here's what gets really interesting, I imagine. What about variable amounts? Like StreamCloud might offer a discount if you refer a friend, or maybe there's a rebate later on.
Exactly. Variable consideration. That covers things like discounts, rebates, refunds, credits, performance bonuses, penalties. It's a long list. Companies have to estimate this variable amount. There are two main ways. The expected value method, basically a probability-weighted average of possible outcomes, or the most likely amount, just the single most likely outcome in a range.
Okay, but estimating, that sounds uncertain.
It is, and here's the crucial constraint. You only include variable consideration in the transaction price if it's highly probable that a significant reversal of that revenue won't occur later when the uncertainty is resolved.
Highly probable. That's a high bar.
It is. It requires careful judgment and evidence. How do companies manage this? Well, they need robust forecasting, historical data analysis, understanding market conditions. It's a significant estimation challenge.
What are the pitfalls there? Getting it wrong seems like it could really mess up the numbers later.
Definitely. Overestimating the variable consideration you'll keep is a big one. That leads to recognizing too much revenue upfront, which then needs a painful reversal later. What's really profound about step 3 is how IFRS 15 forces companies to be almost like forward-looking economists, predicting customer behavior and outcomes, not just recording past events. This estimate directly hits the top line, affecting valuation, investor views, everything.
Wow.
And beyond variable amounts, you also have to think about non-cash consideration, like if StreamCloud took an old speaker as a trade-in. You also consider amounts payable to the customer, like rebates, and the time value of money. If there's a significant financing component, usually meaning more than a year between delivery and payment, you need to adjust for that interest element.
Okay. But like paying up front for a year's subscription, that doesn't count as financing, does it?
Generally, no. Not if it's for genuine business reasons like securing the service or customer convenience. The standard looks for arrangements that are effectively loans.
Right. Makes sense. Okay, that brings us neatly to step 4, allocating the transaction price. So StreamCloud has the contract, step 1. They've identified the streaming and the speaker as separate obligations, step 2, and they figured out the total price, including any variable bits, step 3. Now what? You can't just slap the whole price on one thing, can you?
No, absolutely not. The total transaction price has to be allocated to each distinct performance obligation based on their relative standalone selling prices.
Standalone selling prices. So what they would sell for separately.
Exactly. What would StreamCloud charge for just the streaming service or just the smart speaker if sold on their own? You allocate the total bundle price in proportion to those individual prices. And this allocation, it's done at the very beginning of the contract and generally isn't changed later.
But how do they figure out that standalone price, especially if, say, StreamCloud always bundles the speaker and never sells it alone.
Ah, yes, that's a very common practical challenge. The best evidence, obviously, is if they do sell it separately, that observable price is gold standard. But if not, they have to estimate it. They might use a cost plus margin approach, figure out the cost of the speaker and add a typical profit margin. Or they could look at competitors. What do similar smart speakers sell for in the market? In some limited situations, they might use a residual approach. If you know the standalone price of the streaming service, you could allocate that, and the remainder of the total price gets allocated to the speaker. But that's usually a last resort.
Okay.
This really does raise significant operational questions for businesses. Think about StreamCloud's bundle again. If the speaker normally sells for $100 and the streaming is $10 a month, but the bundle is, say, $90 up front plus $10 a month, IFRS 15 forces them to allocate that $90 between the speaker and the initial streaming access based on their relative $100 and, say, $10 values. It requires potentially complex calculations for every single contract type.
And discounts or variable amounts, where do they go?
Usually, discounts and variable amounts are allocated proportionally across all the performance obligations, unless there's specific evidence that a discount relates only to one particular item.
Got it. So allocation done. That leads us to the final step. Step 5, recognizing the revenue, the moment of truth.
The moment of truth, indeed. This is where the money actually hits the income statement. The core principle is simple to state, harder to apply. Recognize revenue when or as control of the promised good or service is transferred to the customer.
Control. What does control mean in this context?
Control means the customer has the ability to direct the use of the good or service and obtain substantially all the remaining benefits from it. Essentially, they can decide how to use it and get the value from it and stop others from doing so.
Okay. And you mentioned when or as. What's the difference?
That's the crucial distinction. Revenue is recognized either over time or at a point in time. Think about StreamCloud's streaming service. You pay monthly, you watch shows throughout the month. The customer is receiving and consuming the benefit continuously as StreamCloud provides the service. That's classic over time recognition.
Right, like subscription.
Exactly. There are 3 criteria for overtime recognition. One is that simultaneous receipt and consumption, like streaming. Another is if the company's work creates or enhances an asset the customer controls as it's created. Think building on a customer's site. The third is if the work doesn't create an asset the company could use for something else, and the company has a right to be paid for the work done so far, even if the contract is canceled. If any of those are met, it's overtime. And then you need a way to measure progress, maybe based on costs incurred, hours worked, input methods, or milestones achieved, output methods.
Okay, so streaming is overtime. What about the smart speaker in the bundle?
Good question. If none of those overtime criteria fit, then revenue is recognized at a point in time. This is when control actually passes to the customer in one go. For the StreamCloud speaker, that's likely when the customer receives it when it's delivered.
How do you pinpoint that moment?
There are indicators. Does the customer have the legal title now? Do they have physical possession? Do they have the significant risks and rewards of ownership? Does the company have a present right to payment for it? These point towards control having transferred.
Okay.
What's really vital to grasp here is how this choice over time versus point in time dramatically affects the timing of revenue in the financial statements. Recognizing revenue for the speaker immediately upon delivery gives a big upfront revenue hit, while the streaming revenue gets spread out month by month. It changes the shape of the profit curve, how performance looks quarter to quarter.
Wow. Okay, that was a really, really insightful journey through that 5-step model of revenue recognition under IFRS 15. We started with StreamCloud's bundle, figured out the contract, unpacked the distinct promises, the streaming and the device. Then we tackled the transaction price, allocated it carefully, and finally worked out when to actually count the revenue for each part. Each step really does build on the last. It gives this, well, comprehensive framework for how companies handle their most basic financial activity, earning revenue. So what does this all mean for you listening? Well, hopefully understanding these principles gives you a much deeper appreciation for those financial statements you might see. Whether you're looking at a tech giant's earnings, maybe analyzing a company before investing, or even just thinking about that online purchase you made, there's a lot of complexity behind it. It really shines a light on how companies measure their success, how they manage what they owe their customers, and ultimately how they present themselves financially. And as we wrap up,
maybe a final thought to leave you with. With the rise of really complex, customized services and these ever-evolving subscription models, like StreamCloud's offers, getting even more bundled or tiered, how might that continue to challenge or even change how these fundamental revenue recognition principles are applied? Even with a framework like IFRS 15, companies are always innovating. How does the accounting keep up? It feels like a constant evolution, doesn't it?